Global markets are bracing this week for fresh data on US inflation on Wednesday night. And in Australasia, there's wages figures on Tuesday and a monetary policy decision in New Zealand on Wednesday. There's also a batch of new data from China where consumer demand is sluggish. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Economist Krystal Tan examines what a second Trump presidency might mean for Asian exports. Spoiler alert, it's unlikely to be good.
We're talking about a potential 60% tariff. That's a huge increase. It's going to have a significant impact because currently tariffed US imports from China are around 20%.
But first, in 5 and 5 with ANZ. Global financial markets took a breather over the weekend after a wild week and a half of trading that saw volatility spike to pandemic levels. US stock indices closed up between 0.1% and 0.5% on Saturday morning Sydney-Melbourne time, recovering their losses for the week. The US 2-year and 10-year Treasury bond yields were flat, and the US index futures were also flat. The Aussie and Kiwi dollars were both down 0.3% at 4 a.m. Sydney-Melbourne time today. The Aussie at 65.72 US cents, and the Kiwi just a blip under 60 cents at 59.99. The focus on markets this week will be US CPI inflation data on Wednesday night. But in this part of the world, it's Aussie wages for the June quarter on Tuesday and the RBNZ's monetary policy decision on Wednesday afternoon. And on Thursday, there's jobs figures from Australia. Number 2. The other major data to watch will be a batch from China on Thursday, including industrial production, retail sales, fixed asset investment and property investment. ANZ senior China strategist Zhao is also expecting money supply data, but says the economy remains dominated by weak consumer spending and low property lending.
For the financial data, I think it will be disappointing again because the government is trying to remove the excess money from the money supply statistics. So we expect both M1 and M2 growth rate to decline again in July. For activities data, I think data the big picture will not be changed. We'll see very weak domestic demand. Retail sales may grow only 2.6% year-on-year, and fixed assets investment may grow below 4%.
Number 3. Zhao also says China's CPI inflation data for July on Friday may have looked stronger than expected with a headline rate of 0.5% from a year ago, but the underlying picture remains weak. The headline rate was actually better than the 0.3% expected by the market, but it was boosted by some one-offs on the supply side.
The food price has elevated very fast in the past months due to the hot weather and the flood. Because of the improvement in CPI is mainly due to the supply side factors. I think there is no improvement in the inflation in China. So domestic demand, I think, is still very sluggish.
Number 4. Zhao says the People's Bank of China is unlikely to cut rates in the short term to stimulate against that sluggish consumer demand because it cut just 2 weeks ago. He also said fiscal stimulus is not coming to the rescue yet.
I think the fiscal front is very disappointing. First half of this year, the fiscal spending only rose by 2% year-on-year. So the budget book, which is set earlier this year, planned to increase the fiscal spending by 4% year-on-year. It means that in the second half of this year, the fiscal spending could rise 6%. At this moment, I think from the bond issuance, it suggests that the bond issuance process is really very slow.
Number 5. The Philippine Central Bank will be faced with a headache when it looks at whether it can cut rates this month. That's after data last week showed Q2 annual GDP rose to 6.3% from 5.8%. That was led by investment and government consumption. ANZ economist Arindam Chakraborty says a robust labour market also means personal consumption spending will remain strong.
With growth in the US economy beginning to ease, external demand is unlikely to be robust, although the strength in domestic demand will keep imports elevated. This may lead to a widening of the current account deficit. Therefore, given the firm growth in Q2 GDP and above target inflation in July, we expect the BSP to keep the policy rate unchanged at 6.5% in next week's policy meeting.
Arindam Chakraborty there. Now, in our bonus deep dive interview, ANZ economist Krystal Tan talks about what a second Trump presidency might mean for Asian exports, especially after Trump began a trade war with China in his first go-round. which saw American imports directly from China fall 20%. Imports from other countries, though, rose 35%. Krystal tells my colleague Alex Tarrant that Vietnam and Taiwan were particular beneficiaries the first time around.
Now, some of these gains were because of changes that were already happening in their production patterns, but there were certainly also other factors like Chinese products being redirected to these countries and also supply chains being reorganized. But there's an interesting twist. So despite the trade war with the US, China's share of global exports actually increased. So they were able to find other markets outside the US or figure out ways to route their exports through third economies.
And so what's expected to happen this time around then if he retakes the presidency? Will it be something similar, do you think?
Trump's current campaign proposals are far more severe than the trade policies he implemented as president. The first of which is tariffs of 60% or more on Chinese imports and also circumventing their rerouting through third economies. And the second one is a 10% universal baseline tariff on all US imports. Now, in the event Trump wins the election, it's certainly possible that these policies would be either phased in gradually or even diluted with exemptions, for example. So the actual economic impact is going to ultimately depend on the policy details. We don't have clarity on the nuances now, but if we take these policy proposals at face value, well, Asia would be deeply impacted.
So what do we think will happen specifically in terms of what China will do or how China will respond if those tariffs are reimposed on them?
Well, the issue now is we're talking about a potential 60% tariff. That's a huge increase. It's going to have a significant impact because currently tariffed US imports from China are around 20%. So if you triple the tariff rate, that's going to be a big blow. It cannot be offset by just adjustment in exchange rates or export prices. So this kind of scenario is going to disrupt existing supply chains in a major way. We're going to see higher prices, we're going to see reduced profit margins, and ultimately overall growth in both these economies will suffer. And that's going to have negative spillover effects on the rest of Asia. So if we look at economies here, Taiwan and Vietnam in particular, they have a very high exposure to final demand from China and the US. So they would be more vulnerable to slower growth in these economies. Another aspect to consider is that if Chinese exporters face difficulties in accessing the US market, they will then try to strengthen their presence in other non-US markets. So that's going to increase competition for the rest of Asia, not only in non-US export markets, but also within their own domestic markets. So on this front, Asian economies that have a high level of export similarity with China or those with weaker manufacturing bases would be particularly impacted. Vietnam in particular stands out on this front, right? It's benefited a lot from the US-China trade war, but now it could be the most affected. It relies a lot on foreign inputs for its manufacturing exports to the US, and it also imports a significant amount from China. So if this unwinds, then the gains would reverse.
Now, there's talk about a global 10% tariff as well. What could that lead to in terms of global trade?
Well, if a 10% tariff is implemented universally, it probably won't cause a major reshuffling of supply chains, right? Because exporters to the US are on an even footing. So I think the real concern would be how much of that cost would get passed on to the consumers and then the impact it has on their purchasing power. Because most studies actually suggest that the tariffs imposed during Trump's presidency were fully passed on to consumers. So if we're talking about universal tariff now, it's going to affect a broader range of imports. The Peterson Institute for International Economics, for example, estimated that imports subject to tariffs would increase from something like 2% of US GDP to 10%. So this means that the loss in household income is going to be even larger, and that's going to hurt overall demand for goods and services. And to offset this, foreign producers exporting to the US and US importers, they're going to need to lower prices of their goods. They're going to have to adjust exchange rates and potentially make less profit. So there's going to be some burden sharing involved, and that's going to depend on the state of the economy, how sensitive people are to changes in prices for specific products. But all things considered, bottom line is that it's likely that US aggregate demand would fall. So in this context, it's important to look at the exposure of different economies in terms of their dependence on US demand. And Vietnam again stands out to be particularly vulnerable when we consider these factors.
Krystal Tan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, August the 12th. Catch you tomorrow with a look ahead at Australian wages data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. please view the podcast disclaimer available via your media player or email.